A few months ago, I pulled together a video that looked at an alternative way of getting exposure to the US stock market via the NASDAQ 100. Now, I know the S&P 500 tends to be the most popular go-to indexes in the world and is a staple for many investors, including myself. But in this video, which I'll link up here and down below in the description box as well, I talk about why you might want to look at including a NASDAQ 100 tracker in your portfolio. Now, I won't go into detail on why that is now because I do a full deep dive on the ins and outs of why in my previous video on the topic. But I did promise to review some of the best ETFs on the market that track the NASDAQ 100.
In a future video, I'll be looking at the best ETFs on the market for exposure to the NASDAQ 100 index.
So here we are with a follow-up video. Let's jump straight into it. It's worth noting that all of the ETFs I'm going to cover will be domiciled in Europe and conform to European UCITS standards. Now, this stands for the Undertakings for Collective Investment in Transferable Securities, and it dictates how funds are sold and managed to protect everyday investors like you and I. It's a bit of a mouthful, I know, but unless a fund adheres to UCITS standards, you can't buy it here in the UK or Europe unless you can prove you're a sophisticated or professional investor. There are actually a total of 7 NASDAQ 100 ETFs that qualify, with one major difference between them, which I'll cover towards the end of the video. So do stick around for that, as it's a really important factor when it comes to choosing an ETF. The iShares NASDAQ 100 ETF is the first ETF on the list with ticker symbol CNX1. Launched back in 2010, it has the biggest fund size of all of the ETFs we'll look at, with nearly £8 billion invested at the time of recording. If you're not aware, iShares is a subsidiary of BlackRock, the world's largest asset management company. So you'd like to think that you're in safe hands when it comes to ETFs from this fund manager. However, this does come at a price, as the iShares NASDAQ 100 ETF is the most costly on the list, with an expense ratio of 0.33%, which means you'll pay £3.30 for every £1,000 invested in this fund. It also has an indicative spread of about 0.07% at the moment. Now, the spread is just the percentage difference between the buy and sell price of a share, which tends to vary throughout the day, and ideally you want this to be as tight or as narrow as possible when buying or selling regularly, but probably not so much of an issue if you're a long-term investor that's looking to buy and hold for the long term. It's currently trading at around £66.40 per share, so definitely a reasonable entry point if you prefer to buy whole shares or you're unable to access fractional shares with your investment platform. It happens to be an accumulating fund, so any dividends are automatically rolled up and reinvested back into the fund without you having to lift a finger. Like all the ETFs I'll talk about in this video, this ETF is also suitable to be held in tax-sheltered accounts like an ISA, lifetime ISA, or a SIP, which are really important when it comes to protecting any gains or profit you make from the taxman. Second on the list is Invesco's NASDAQ 100 ETF, ticker symbol EQQQ. Now, this ETF is actually the European version of the very popular US ETF QQQ, which tracks the same index and is managed by the investment firm Invesco. Launched in 2002, EQQQ has a fund size of over £3.9 billion. It has the second highest expense ratio of all the ETFs on offer at 0.3%. So you'll end up paying an annual fee of £3 for every £1,000 invested. It has an indicative spread of about 0.03%, so more than half of what we saw for the previous iShares ETF, which is good. At the moment, it's trading at the £28.50 mark, so a lower barrier to entry when it comes to buying whole shares. This is a distributing ETF, but there is an accumulating version available under ticker symbol EQGB, which is also hedged to British pounds. Next, we have Xtrackers NASDAQ 100 ETF, ticker symbol XNAQ. It's managed by Deutsche Bank's ETF platform Xtrackers. This ETF was launched 2 years ago in 2021 and currently has a fund size of about £270 million, so quite a bit less than the iShares and Invesco giants. It does have the lowest expense ratio so far, though, of 0.2%, with a yearly fee of just £2 for every £1,000 invested. Currently, you can buy into this ETF at around the £26.70 per share mark, so again, not so high to put off anyone that prefers or can only purchase whole shares. This ETF is accumulating, so dividends will be automatically paid into the fund rather than be paid out to shareholders. Fourth on the list is the Lyxor NASDAQ 100 ETF, ticker symbol NASL. This fund used to be managed by Lyxor Asset Management, but in 2022 their ETF fund unit was bought out by Amundi, a French company that is the largest asset management firm in Europe. This Lyxor fund has over 1.5 billion of assets under management. It's been around for a while now, since 2001, so isn't totally new to the ETF scene at all. It has an expense ratio of 0.22%, so you'd incur an annual fee of £2.20 for every £1,000 invested in this fund. You are able to buy a share in NASL at the £46.70 mark, and again, it's another accumulating fund, so you won't see any of the dividends being paid out. Kind of linked to the Lyxor ETF by the merger I mentioned earlier, we have Amundi's NASDAQ 100 ETF at number 5 on the list. This has the ticker symbol ANXG, and it's a much smaller fund at £160 million. It came onto the ETF scene in 2018, so it's younger than the Lyxor ETF, which probably explains the smaller fund size. It has an expense ratio of 0.23%, so it will cost you £2.30 for every £1,000 you've got invested. You can purchase a share in this ETF for around £131 per share, so it's a little at the higher end if you're not able to buy fractional shares. Like the Lyxor fund, this one is also accumulating. At number 6 on the list, we have another Invesco product called the Invesco NASDAQ 100 Swap ETF with the ticker symbol EQSG. It has a fund size of about £130 million and was first launched 2 years ago in 2021. This is actually an accumulating ETF, but it does have a sister ETF under the ticker symbol EQQD, which is a distributing version of the same fund, launched in the same year and forms the final ETF on this list. Both ETFs have an expense ratio of 0.2% per annum. The distributing version has the smallest fund size of all the ETFs we've looked at, totaling £23 million, so not as popular as the others just yet. Now, if you're an eagle-eyed viewer, you might be wondering why the last 2 ETFs have the word swap in their titles. And this brings me on to the key difference between these funds that I mentioned at the beginning of the video. The first 3 ETFs, so the iShares, Invesco and Xtrackers funds, are all traditional full replication or physical replication ETFs. This means that they track or replicate the index by directly buying the underlying securities or shares of the NASDAQ 100. This is to be expected because the goal of an ETF is to track the performance of an index as accurately as possible. So to track the NASDAQ 100, a full replication ETF will invest in the same companies that comprise the NASDAQ 100 at the same percentage weightings. I'll pop the current company weightings on screen now for the NASDAQ 100, but remember these change depending on the market cap of each company. So any ETF that tracks the NASDAQ 100 or any index for that matter, will also have to adjust its weightings over time. Remember that you can't invest in an index like the NASDAQ 100 directly, so a fund like an ETF is the only way to mimic its performance directly. I'm sure this is pretty much what you'd expect of a tracker ETF, to be a physical replication of the index you want to track. It makes common sense. But on the other side of the coin, you also have synthetic ETFs. The last 4 ETFs on the list I ran through are synthetic ETFs, which are basically a more exotic version of a traditional physical ETF. A synthetic ETF is designed to mirror the performance of an index, but instead of directly holding shares in the companies within the index, they use financial engineering to achieve the same performance, usually in the form of derivatives or swaps. This is where an ETF provider enters into a deal with a counterparty, which is usually an investment bank, and that counterparty promises that the swap will return the value of the corresponding benchmark the ETF is tracking. Now, it's a little complicated how these work, and I could probably do a whole entire video on the pros and cons of both physical and synthetic ETFs. The main sticking point around synthetic ETFs is that they've always been seen as a bit risky because of the counterparty risk involved. Typically, the fund manager has no physical holdings in any of the companies listed in the index. Instead, it's relying on another party or a bank who promises to pay the return on the index into that fund. But if that bank defaults on the deal or goes bust during a financial crisis, then you as an investor potentially have a big problem. Now, you can break synthetic ETFs down further into funded and unfunded. The last 4 NASDAQ 100 ETFs I talked about were all unfunded. I won't go into detail on this now, but if you've never heard of synthetic ETFs before or you're not sure of the risks involved, then I would stick to the traditional ETFs that form the top 3 on the list. Those are the iShares NASDAQ 100 ETF, the Invesco NASDAQ 100 ETF, and the Xtrackers NASDAQ 100 ETF. Gosh, that was a bit of a mouthful. I have included all of the corresponding ticker symbols in this table as well, so feel free to pause the screen and have a bit of a browse at those if you want. Ultimately, which NASDAQ 100 ETF you choose totally depends on your own personal investing priorities and preferences. There are so many factors to consider when choosing an ETF, including things like the ongoing charges, the size of the fund, how long the fund has been in existence for, how accurately it tracks an index, how it distributes its dividends, etc., etc. Personally, I hold Invesco's swap accumulating ETF in my Trading 212 ISA, which works for me at the moment, so I'll be sticking with this for now. If you're keen on opening an investing or ISA account with Trading 212, then I do have a link in the description which will get you a free share if you open an account. I can't promise it will be a share in a NASDAQ 100 ETF, but you never know. Hopefully this video gives you some ideas of where to start your own due diligence when it comes to researching different ETFs if you're interested in getting a bit of the NASDAQ 100 into your portfolio. Please do give this video a like if you found it useful. Thanks so much for watching, and I will see you in the next video.